thing about this book, this advanced accounting book that we're starting, the readability is really better than your intermediate book. So you're going to like that. And so we're going to start with our, on the chapter outline. You'll notice the font's a little different, but it's kind of in the same format. But I just kind of copied and pasted for this outline because the instructor's manual was really good. So in chapter 1, and we only have chapters 1, 2, and 3 in this course. In chapter 1, we are reviewing what we did in chapter 17 of the intermediate accounting book. The investments, and only the equity investments, not the held to maturity and not the other debt securities. Okay, so it's just the investments, equity investments, stock. Okay, so as the book will tell you, there are 3 methods that are used to account for an investment in equity securities that have a fair value option. First of all, we use the fair value method, secondly, consolidation, and thirdly, the equity method. Now, I will tell you that that is not true. That there are 2 methods when you come to journal entries. The fair value method and the equity method are the 2 methods for journal entries. That consolidation is not a journal entry method. It is a reporting method. So we're going to review the fair value. All we did in chapter 17 was the fair value method and the equity method. But what I do want you to know is that we do, and the whole book, the first 7 chapters is consolidations. So these 3 chapters are all about consolidations. All right? So let's review the fair value method. The first thing, the fair value method, remember this is a small, insignificant, minor part. So the portfolios that I have, I own like 0.00000000001%, you know, of the stock of a bunch of different companies. So can I go to the board meeting? Yes. Do they care if I go to the board meeting? No. And what am I hoping for when I'm an insignificant, minority, tiny little amount of stock? I'm hoping to buy low, sell high, and make a gain when I sell it. And I'm hoping maybe to get a dividend. That's it. So that in the fair value method, our income is dividend revenue. When we sell it, we have a gain or loss on sale of stock, whether it's an AFS or trading. AFS stands for available for sale, right? Which means it's either not planning to be sold or there is no market, so we can't sell it. But we're not planning to sell it soon. Whereas the trading securities, their definition is we are planning to and able to sell them soon. Trading and AFS, remember that? And as we review this in the intermediate book, we remember that trading securities and available for sale securities, we have these adjustments to fair value. So we have a portfolio of AFS and a portfolio of trading securities. And then every time we do a financial statement, we measure to see whether the portfolio, we want to report it at its fair value, the fair value of the portfolio. So we'll have either a contra account, less adjustment to fair value, or an adjunct account plus adjustment to fair value, right? For the portfolio. And with the trading securities, since we're selling them soon, that adjustment does go to the income statement. Okay? Unrealized gain. But for the available for sale, since stocks go up and down, and we're not planning to sell them soon, that is an OCI. That's one of our OCI, other comprehensive income. So they look the same on the balance sheet. AFS securities plus or minus adjustment, right? But as we make an adjustment to that adjustment account, as we make a journal entry to that adjustment each year, trading securities will go to net income as an unrealized gain on the income statement, but AFS will not. They will be in OCI. Okay? I'm just trying to remind you of what you learned in chapter 17. Okay, so the income, by the way, is going to be recognized when the investee, okay, the investor is the one who bought the stock. The investee is the one whose stock they bought, right? So let's get our investee, investor terminology, right? We are accounting for the investor, but when the investee declares a dividend, they have created a liability, and we as the investor have income under the fair value method. So far, so good. The portfolios are reported at fair value. Okay. As opposed to the equity method, we have the ability, whether we exercise it or not, the ability to exercise significant influence. So if I own 27% of one of these stocks in my portfolio, I am a big horse. They do want me to come to the meeting because I can get some proxies from other people, and I could even have more than 50% if I've got your proxy and his proxy and your proxy and your proxy, and I take them all in there and I vote as a block, and I've got over 50%. I can get my way.
So each one of your shares is a vote still?
Yes, it's still the same. I still only own 27%, but if I can convince you to let me vote your shares, and you have another 30%, then I'm voting 57%. And whatever I say goes. So I have the ability to exercise significant influence. We obviously have that when we're over 50%. There's no question we control. Control is more than 50%. And as we do these three chapters, once we get to chapters 2 and 3, consolidation, when we control, we do consolidation. We put both companies together. We consolidate. It's like your mashed potatoes and gravy and your lima beans you don't like, and you mush them together so that it all tastes like gravy. Okay? That's a consolidation. Even if we don't own 100%, if we own more than 50, then we control 100. And therefore we consolidate. So far, so good. All right? But consolidation is not what we debit and what we credit. Consolidation is simply a worksheet that we do to mush them together. We take the adjusted balances of the parent and the adjusted balances of the subsidiary. We do some consolidation entries. Sometimes the debit is to the parent and the credit to the subsidiary, sometimes vice versa. Every now and then, they're both to the parent or they're both to the subsidiary. But you can't make a half of a journal entry. So consolidation entries are never recorded. They're only on a worksheet. Okay? That's why I'm telling you there really are not three methods. There are two accounting methods in doing journal entries. Fair value or equity. Consolidation is what we do if we control. And we should have used the equity method, but we don't always, and we'll get there. Okay? So equity method is used when we have the ability to exercise significant influence. Below 20%, thank you, below 20%, we assume we don't have that ability. Above 50%, we control, so we do have the ability. Between 20 and 50%, they have to tell you whether you have that ability or not. The problem must tell you. So if it's 35%, you might do fair value, you might do equity. You would do fair value if somebody owns the other 65%, right? Because you obviously don't have that ability. But if you're the biggest stockholder at 35%, and everybody else is just little stockholders, then you might very well have that ability to exercise again. So it must tell you between 20 and 50. Below 20, we assume no. Above 50, we know yes. So we have to be told. So we have an illustration on pages 8 through 13. If you have your book, okay, pages 8 through 13. And so we want to go over that, but we're running out of time right now. So we're going to do that next class. That's where we're going to start. Illustration on pages 8 through 13. Okay, so that's it for today. We'll go ahead and take that. That wasn't very much, but it was the introduction. That's where we're headed. The first chapter is all review, fair value, equity, method,